Hello, welcome to Five Common Mistakes Truckers Are Making That Is Costing Them Thousands of Dollars. Who am I? I am Keisha West. I am number one, a servant leader. I believe in using my skills, gifts, and talents to serve God's people. What I do. I am an enrolled agent licensed by the Internal Revenue Services. I specialize in individual and business tax preparation and resolution. Also, I'm the owner of Virtuous Tax Financial Services, where we specialize in financial services for the trucking industry. Also, I'm known as the Trucker Financial Strategist on social media platforms. Let's talk about CPAs versus EAs. I know a lot of people are familiar with the term CPA, which is a certified public accountant. They specialize in assurance services that certifies the company financials. So they specialize in audits, examination, and reviews. A CPA, they are licensed on the state level. For example, if they're licensed in the state of Georgia, then they can represent someone in the state of Georgia. Now, an enrolled agent, we specialize in tax law, tax resolution. We do provide some accounting services such as bookkeeping. We also provide tax consulting, and we are licensed on the federal level. So we're able to represent anyone in the USA. A lot of times, CPAs and EAs, we work together to get the best results for our clients. For example, all CPAs do not prepare taxes. All EAs do not do bookkeeping. So we kind of use each other's services interchangeably just to get the best result for the client. So if you're looking more for someone to certify your business financials and give you guidance on the finances of your business, then you may want a certified public accountant. If you are looking for someone who specializes in that tax code and you're trying to, reduce your tax liability, then you may want an enrolled agent while we do both provide interchangeable services. The objective for this webinar is to inform truckers of five common mistakes and provide solutions to fix them. Before I get started, I want to give out a quick disclaimer. Taxes is not a one size fit all situation, and what works for one business may not work for yours. This information is for educational purposes only. To determine what is the best for your business, I highly recommend that you all schedule a one on one consultation. But not only that, you all, I want to also add that if any of these things apply to you or your company, my goal is not to make you all feel bad or pass any judgment, but to meet you where you are and help you get on the right path. Let's go. Okay, number one, converting to S Corp too early. I know. You heard that converting to an S Corp will save you thousands of dollars. While that is true, remember I said what works for one business may not work for yours. So let's talk about what an S Corp is. So S Corp is simply an election that is made to the Internal Revenue Services to let them know how you wish for your business to be taxed. So when you automatically form your business, you don't determine if, it's a S corp or whatever. You just form your business and you have to file documents and send it to the IRS to elect to be taxed as an S corp. So at one time, social media was going crazy telling people to convert in S corp and save in taxes. But remember, you all, on social media, that's just a snippet of information. You have to consult with a professional to determine what would be the best fit for you. So many people converted to an S corp without understanding the requirements to effectively maintain the S corp election. The disadvantage to this, you all, is that if the rules are not followed, that can cost you thousands of dollars because the IRS will reclassify some of your earnings and you will have to pay additional taxes on that. Trucking is a high revenue, high expense industry, and many people have low profit margins. Your profit margins need to be evaluated before you convert to a S corp. Now let's talk about some of the requirements of even being an S corp. So, number one, you must be a domestic company, meaning that your company is organized and it operates in the United States. Your shareholders, they must be eligible. A shareholder, is a person or institution that has invested money into the corporation in exchange for a share of the ownership. This can be an individual, it could be a trust, an estate. However, partnerships and corporations and non-resident citizens, they cannot be shareholders. So you want to take all of that into consideration when you are thinking about, being an S corp. The S corp, they cannot have more than 100 shareholders, and they can only have one class of stock. That simply means that the terms and the way that you all are giving out your distributions and liquidating rights and things, they must be one and the same. So a lot of time people they're converting to S corp, but they don't have the foundation properly set. When you convert to a S corp, you must have reasonable salary. So you have to put yourself on payroll and you have to pay yourself a reasonable salary. Now, in the eyes of the IRS, a reasonable salary does not mean that you can just pay yourself $20,000 and that's all you have to pay taxes on. No. A reasonable salary, it plays a lot into the individual business owner, where you live, what someone in your area may work for the job that you're doing. So a lot of factors come into play. You must have an accountable plan. So the accountable plan is a plan that allows a business to reimburse you for the expenses that are related to the business, such as your internet costs, your mileage driven for the business. Without this accountable plan, you are not allowed to be reimbursed. Okay, bookkeeping. A lot of people feel that, they can do their own books, but when you become an S corp, there are certain things that need to be in place and you need to show account for in your bookkeeping. But not only that, your administrative fees for having a S corp are much much higher, because now that you have an S corp, you're not just having one tax return done, you're having two, because you're going to be taxed on the individual side, but informational return has to be completed for that S corp and is not cheap, you all. So before converting to an S corp, you want to sit down with a professional, have them evaluate your situation to determine if converting to an S corp is in your best interest. Because what can happen is that if you are not properly set up, if you're audited by the IRS, some of the money that you have taken out of the business as a distribution could be recategorized and you have to pay taxes on that. There are definitely some benefits to becoming an S corp, definitely, because you would save in some self-employment taxes, but you want to make sure that it is the right time for you. Okay, number two, mixing personal and business income and expenses. So, you all, I highly recommend that you open up at least a business checking account and a business savings account. And that's at a minimum, because I do understand you do need other accounts such as maintenance accounts, but that's a story for another day. At least open up a business checking and savings account, because mixing your personal and business expenses, it can cause you to miss out on tax deductions. Because let's say if you took a potential client to lunch and you didn't document it, at tax time, you're not gonna even remember that. And it may seem like a small expense, and you'd be like, "Oh, I'm not worrying about that." You are, but those small expenses is actually what can really add up quick, and you could really help. It could help you reduce your tax liability. But when you're mixing your personal and business, operations, that puts you out of compliance. Even if you're a sole proprietor, meaning that there's no differential between you and your business, or you haven't registered your business with a state, I still recommend that you separate your financials, because you want to have an accurate picture of your business operations. Also, if the IRS audits you and they see that you have those personal and business transactions together, they can disallow some of those expenses if you don't have documentation that provide proof that it was actually business related. This can cause your income to be higher, and you to actually potentially owe in taxes. So that's why it's highly, highly recommended that you do not mix your business and personal operations together. The IRS, they're really, really big on that, you all. Number three, misclassification of employees versus independent contractors. Now, this is a big issue in the trucking industry. Many trucking companies, they misclassify their drivers to avoid paying payroll taxes. This become a problem because some drivers, they're thinking that the fees that are coming from their earnings is including taxes. So if you are owner operator, if you are owner of a trucking company and you have independent contractors, please let them know that they are responsible for paying their own taxes. They will appreciate you all so much more. When I've been working with these truckers and I tell them that they have not paid nothing into taxes and they actually owe a bill, they become really, really frustrated, and angry with their employer, thinking that they're their employer when they are in fact their own independent contractor. So please educate your drivers and let them know that they are responsible for paying their own taxes. But let's talk about the three factors that the IRS uses to determine whether a person should be an employee or an independent contractor. Okay, number one is the behavior. So you want to ask yourself these questions. Does the company control or have right to control what the worker does and how the worker does his or her job? If yes, then they are more so needs to be classified as an employee. Okay, financial. Are the business aspects of the worker's job controlled by the payer? These include things such as how the worker is paid, whether their expenses are reimbursed. Also, it includes things such as who provide the tools and the supplies. So a lot of times these trucking companies, they are providing you all with all the tools you need to do the job. And they are reimbursing you all for things that you may have paid for the company. If they are doing these things, then you are supposed to be a employee and not an independent contractor. Because think about it, if you are an independent contractor, you're independent. You provide all of these things yourself. No one should not be providing them for you. So keep that in mind. That's on the financial aspect. And then we have the type of relationship. So ask yourself questions like this. Are there written contracts? Or are there any type of employee benefits? That includes things such as pension plans, insurance, vacation pay. Will the relationship continue? And is the work performed a key aspect of the business? So normally, if you have a contract with somebody, at some point, the relationship should end once the job is complete. But if you are an employee, then the relationship, it continues until you decide to go somewhere else. So those are some things that you really need to think about when classifying these drivers. Are they in fact independent contractors? And some consequences of treating an employee as an independent contractor. Think about this, y'all. If you classify an employee as an independent contractor and you have no reasonable basis for doing so, then you may be held liable for paying employment taxes for that driver. And some things that are happening is once these drivers are finding out that you all are classifying them wrong, what they are doing is they are filing for Social Security tax because it's a form that, misclassified workers can file. And it's the Social Security tax form if they believe that, they have been improperly classified as an independent contractor by an employer. So who do you all think the IRS is going to contact once this form is submitted to them? Because they are going to want those employer taxes that was supposed to have been paid by the company that the company left in the hands of the actual driver. So you want to make sure that you are classifying your drivers right, because it can cost you thousands of dollars in employment taxes that you have not been paying, especially if you have more than one driver. So again, three factors that you want to consider when classifying these drivers are: what's the behavior of the relationship? What's the financial responsibilities of these drivers? And what type of relationship is it? Is it an ongoing relationship, or are we going to part ways once our contract has been completed? Think about it. Okay, number four, failure to pay quarterly tax payments. You may also be familiar with the term estimated tax payments. Okay, let's talk about what they are. So the IRS, they operate on a pay as you go system, pay as you earn system. So let's just say between January and March, you made a certain amount of money, and if you are expected to owe $1,000 or more if you're an individual or LLC, or a 500 or more if you're a corporation. If you're expected to owe those amounts, then you should be making quarterly tax payments. This allows you to pay as you earn your income. So when you file your taxes come March or April, then you won't have this large tax bill because you will have made those four payments throughout the year. So, a lot of people are not doing this, and this is causing them to have additional debt because they're having to take out loans or try to take out loans, borrow money just to satisfy their tax obligations. Well, that becomes a problem because a lot of people, once they find out that they owe this money, they don't file their taxes. And it may come a time where they want to obtain funding, and the first thing they're going to ask for is those tax returns that you had filed for the previous years. So this can be a problem with you obtaining funding when you're trying to scale your business, buy extra equipment. You're not going to qualify because you won't be in compliance with your taxes. This can lead to stress. If you're not able to get the funds that you need to operate your business, that can be very stressful. That will lead over into your relationships, whether you're married in a committed relationship. That can be a problem that interrupts the way your family is, living. So you want to make sure that you are on top of these quarterly payments so that you can get the things that you need to successfully scale your business, but also so you can provide for your family. Okay, and number five, doing everything yourself. This is a big one. This is something that I had to overcome, you all, because in the beginning, if we're just starting out, we're trying to save as much money as we possibly can. And let's face it, some things that we can do ourselves in our business. But what happens when you have been self business working, in your business, that you're not able to work on the finances of your business because you are there to drive the truck or to run the operations of your drivers, to make sure that you are maintaining in that area. You're not expected to be a tax professional, a CPA, an enrolled agent, an accountant. All of those things, they have people who are in place to do that. So when you're trying to do everything yourself, this leads to frustration because there's no action being taken because you don't have the skills to actually do those things for the business. You're overpaying in taxes because you are not updated with the tax law, and you're not expected to be so. But you're overpaying in taxes because you're just rushing during your taxes and not realizing that there are actually some things that can help you reduce your tax liability if you only knew. A lot of people are binge watching social media. They're becoming with information overload because there's so much information out there, and we try to determine what fits our business, not realizing that some of those things just do not fit for your business. When you do that, you prolong during your taxes. That leads to you having penalties and fines, which make your tax bill even higher, which leads to more frustration. A lot of people, they're being stuck here, and they're actually shutting down the operations of their business because they feel that it's too much and they just cannot take it. Well, when you're trying to do everything yourself, this is a very common feeling. So I highly, highly recommend that you consult a tax professional in your industry that knows what applies to you to help you all be successful. Stop trying to do everything yourself, because when you do that, you are costing yourself thousands of dollars. Thank you. Thank you all so much for joining me for 5 common mistakes truckers are making that are costing them thousands. I am Keisha West. You can join me on TikTok at Truckers Tax Strategist, where I provide educational content for the trucking industry. Also, you can visit us at virtuoustaxfinancial.com. We are the resource hub for the trucking industry. We provide all financial services. Also, you can give us a call at 404 436 1366. I look forward to serving you all.